Good evening, guys. I welcome you on behalf of ACCA Global and Scan School of Accountancy, Islamabad. I hope everyone is doing fine. This is day 4 of our webinar, and we have discussed different topics along with examples and questions. I have tried to make the concepts clear for you guys, and I hope it has worked for you. As long as the WhatsApp group is concerned, uh, it will be live by today. I have noted down the numbers that I received. I will be making a WhatsApp group once all the students share their numbers so that I could make this group. Okay. So guys, uh, we started a question in our previous session, and I requested you guys to go through the question by yourselves and try to attempt it. And I believe that you have tried to do this. Now I will be concluding this question, a little refresher for the people who are missing out tomorrow. We have discussed the exam technique, and quickly going through the exam technique, we will not be wasting time on writing the content that is not being specifically asked by the examiner. We will only be focused on the requirements as asked by the examiner. No time will be wasted on things not asked. This is the topmost priority, and we will be trying to maximize, we will be trying to solve the question to 100%, since when we have done 100% of the paper, there are more chances of getting through the exam. The topics we have covered with questions and examples were basis period, trading losses, capital allowances, some portion of the corporation tax, some portion of residency criteria, and some portion of capital gains tax, etc. Uh, you are you are all welcome to please pardon for this disturbance. I hope this settles shortly. I would request you a minute so that I could settle this disturbance. Wait for just a minute or two. Sincere apologies for the delay. Okay, so we were in a scenario where your manager had a meeting with your client Freya, and the manager sent you the memorandum plus the email in which there were certain requirements that were asked. Now, the requirements were pretty straightforward. We discussed them. It says carry out the work required as requested in the email from your manager. The following marks are available. Sale of business. See, this is a classic question which is actually giving you an idea of the requirement that is broken. Some of the requirement part is available under required. Some of the requirement part is available under as instructed in the email of your manager. If you could see the email of your manager, the email of the manager says, please carry out the following work. Number one was sale of business. Calculate her CGT, which would be payable by Freya on the sale of her business if she does not incorporate her business but simply sells all her business assets for 2.3 million on October 31st, 2020 to an unconnected purchaser. Explain the rate of CGT which would be charged. The annual exempt amount will not be available to Freya as she is a high rate taxpayer in the year of sale. Now, uh, this requirement coupled with this requirement gives you a clear idea that as per this particular instruction, you have to work for the sale of business. Now, this scenario says that some business assets, it never says some, it says whole of the business assets. If you could go back to the question, Freya has received an offer of 2.3 million from an unconnected party for all the assets of the business. So, if the offer is accepted, her only chargeable asset for capital gains tax purpose will be the goodwill and her business premises. The aggregate chargeable gains in respect of these assets is calculated already. It is 850,000. We do not need to waste our time on the calculations. I have already focused on this in previous sessions that the calculations already provided by the examiner are not to be tested again and again by you. You will be wasting your time. Nothing else would be yielding out of it. However, once she is no longer once she is no longer working full time, Freya intends to live in the country. I'm just skipping it for a while. Looking into this information and looking into the requirement, it is a classic case of the application of entrepreneur relief. Entrepreneur relief, if the conditions of the entrepreneur reliefs are met, this can easily be qualifying for entrepreneur relief where the applicable rate of capital gains tax is 10%. You could see it is very meaningful that it is written here that sale of the shares is to the unconnected purchaser. When you make a sale to an unconnected purchaser, the application of gift relief or some lesser consideration is wiped out. So you are making a legit sale, you are making a sale on the market value basis and the market value basis to an unconnected person, and it is going to be qualifying for entrepreneur relief if the shares if the assets and the business was owned for more than 1 year and the other conditions of the entrepreneur relief are being met. I have answered this question. Against CGT payable if Freya remains in UK and sells business assets. If Freya remains in UK and sells her business assets, rather than incorporating, her CGT liability would be 85,000, 850,000 into 10%. The rate of CGT will be 10% due to the availability of entrepreneur relief. This relief will be available because Freya would have disposed the whole of her business which she has owned for more than 2 years. So the basic idea here is that by skimming through the information, you have understood that the preconditions of entrepreneur relief are being met and the gains as already calculated by the examiner for you, they will be directly multiplied by the rate of 10% as of entrepreneur relief. If there are any questions relating to this part, you are more than welcome to ask. Where are the questions? Here are they. Okay. So any questions are welcome if there are any in this part. And if you want me to go through the question again, I can go through it. I am assuming that we have done a lot of work we have spent a lot of time on understanding this question in detail in the previous session, so we could just move on with the solution so that we can cover the other aspects of the reliefs that you people requested me to do. Okay, now what is the second requirement? The second requirement says, explain the CGT implications on the proposed sale of Freya's business to FIM Limited in exchange of shares worth 2.3 million. I can confirm that all conditions necessary for incorporation relief to apply to this transaction will be satisfied and no election will be made to disapply this relief. So it clearly says your manager is telling you that the sale to FIM Limited qualifies for incorporation relief. Let's go back to the question and see the concern part. It says, however, once she is no longer working full-time, Freya intends to live in the country of Canada and is asked to consider whether she would save UK tax if she were to delay the sale of her business until after she has left UK. I agreed to advise Freya on the following strategy. On 31st October 2020, Freya will sell all of the assets of her business to FIM Limited, a UK resident limited company, in exchange of ordinary shares of worth 2.3 million. Freya will own the whole of the ordinary share capital of FIM Limited. Freya and her family will move to Beneda on 5th April 2021, and on 30th April, after moving to Beneda, Freya will sell the whole of the ordinary share capital of FIM Limited. Now you have to understand the scenario that Freya is going to sell the shares to FIM Limited, and the shares worth 2.3 million. They will be sold to Freya. After some time, Freya will move with her family to Beneda, and once she has moved to Canada, after some good 25 days, she is going to sell out the share capital of that company to which her business was sold. So these are the links that you have to be very much clear with in order to understand and in order to put up a right quality answer. So the question was saying, so the question here was concerning with the sale of business in this fashion, the most So the answer in this case, if it has already been determined that the conditions for incorporation relief will be satisfied, so no working has been done for this since your manager has confirmed that the incorporation relief is being applied. Incorporation relief will defer all of the chargeable gains arising on the sale of the assets of the business so that no CG2 would arise. Instead, the gains will be deducted from the Freya's base cost in the shares that she will be getting. See, you have to understand one thing here, that when you are getting shares as consideration, no cash is coming your way. If you do not have any cash, then you will not be in a position to pay any taxes, and HMRC considers it as very legit and valid, and this says if no cash has been received, no CGT is required to pay. Instead, the gain is subtracted from the market value to calculate the base cost, so that in future when we will be using this base cost for any sale, the gain that we originally rolled over or deferred will automatically become chargeable. Any questions till now, students? I am attempting this question quickly because we have spent some handsome time on it, and I really want to cover the reliefs for CGT and IHG today, and I have selected a question for it as well, and I hope we conclude it. And for tomorrow's session, I would request you to please type the topics you want me to cover so that I can make notes of it, and it will be shared accordingly. Okay. So what is the third requirement now? The third requirement here, on the assumption that Freya lives in Canada for 3 years from 5th April 2021 in accordance with the ideal scenario, explain her UK resident status for those 3 tax years. I have done some preliminary work on Freya's resident status and can confirm that Freya will neither be automatically non-UK resident nor automatically UK resident while she lives in Canada, so that the status for Freya is not going to be clear. She is neither non-resident or automatically UK resident. So you have to be very much careful that this information has already been provided to you. So you have to select the specific ties that are under question here. Okay, let's go back to the question and see. Freya's ideal scenario says Freya would like to live in Canada for no more than 3 years. So these 3 years are very meaningful here. She would buy a home there and would also retain a home in UK. So she is having a residence in UK and she is having a residence in Canada as well. Freya, and having a residence in UK even after leaving it is a very critical point in case of residency status. Okay, Freya would stay in her UK home for 55 days each tax year, of which 25 would be working days. She would spend the rest of her time in Canada. Freya does not intend to carry out any work in Canada, so she is moving for relaxation. Maybe no work is going to be done in Canada. Freya's husband and children would remain in Canada throughout the 3 year period and would not be resident in the UK. So they are not coming back to the UK. So if this is the case, how can we answer this? Now, this answer, you have seen that the first part is worth 13 marks. You just cannot give a brief introduction of the residency rules applying here. You have to be very much careful about providing all the relevant information so that you are able to score the maximum out of the available marks. While living in Canada, Freya will not satisfy any of the automatic residency tests. Obviously, the automatic residence tests are not being met, as it has already been mentioned in the question that your manager has sent you. Accordingly, it is necessary to consider the number of ties which she will have with the UK and the number of days she wishes to spend the time in UK. The ties to be considered in respect of tax year here are spouse or children under 18 who are UK resident. Further, any accommodation available in UK for a continuous period of more than 90 days which was stayed in for at least one night during the tax year. The third one is working in the UK for 40 days or more in the UK for more than 90 days in either or both of the previous two tax years, 2021, 22, 22, 23, and 23, 24 onwards. Spend more time in the UK than any other, spend more time in UK than any other country in the world. Now, if you look at Freya and if you look at these tests, we could easily say that Freya will be satisfying the two ties in the tax year 21-22 and 22-23 and only one tie in the subsequent year. Therefore, she can spend up to 90 years in the UK in each of the first two tax years and up to 120 days in each subsequent year without becoming UK resident. In conclusion, if Freya lives in Canada, as per her ideal scenario as described in the question, for example, returning to the UK for 25 days and 30 additional days in each tax year, she will not be a UK resident in all years. I hope you have gathered this sense of attempting the question, that you are not engaging yourself in testing the information that has already been tested by your manager and confirmed by her that these are the facts of the question. You have to move with those facts of the question and you have to apply rest. And so we defined the ties that could be that were applicable there, and among those ties we have identified the relevant ties, and by identifying those relevant ties and linking it with the scenario, concluding it for Freya that if what she has proposed in her ideal scenario is being adopted, she will not become UK resident in all the years under question. Any problems till now? I can open this. Evelyn, is it going good for you today? That's nice. Okay, let's just shrink it. And now we go back to the last part, that the sale of shares in FIM Limited. We have already gone through that. Once she moves out to Beneda, after 25 days of her moving out, she will sell the shares in FIM Limited. What will be the practical implications of that? Without incurring a UK CGT liability, in order for there to be no UK CGT on the gain on the sale of shares in FIM Limited, Freya would need to. It says that if you want no CGT liability arises, you have to do these following things. And it says that not being resident in the UK in the tax year of sale. If you are resident in the UK for tax year of sale, then the scenario is changed for you. And the second says not a temporary non-UK resident. So you are either not resident in UK and you are not a temporary non-UK resident. This has been confirmed. It has already been determined that Freya will not be UK resident while she is living in Canada. The temporary non-UK resident rules prevents individual avoiding UK CGT by realizing chargeable gains while they are outside the UK for relatively shorter periods. Now, what happens is, what people do, they are not uh, resident in the UK and they carry out their CGT transactions so that they could avoid CGT. But the non-UK resident rules, they are actually the tax avoidance rules here, and they does not allow you to simply avoid the tax by making such kind of moves. It says these rules will apply to Freya because she will have been a UK resident for at least 4 years out of 7 years immediately to the year of departure, and to the shares in FIM Limited because they will be owned by Freya on the day she leaves in the UK. She leaves the UK. So shares were her property when she was leaving the UK, and it says out of 7 years, you have to be you will be considered UK resident for at least 4 years out of the coming 7 years. Now, in order not to be caught by these rules, Freya will need to remain non-UK resident for a minimum period of 5 complete years rather than 3 years in her ideal scenario. She was suggesting that she will remain there for 3 years. No, if she remains there for 3 years, the rule will automatically catch her, since out of 7, she will not be completing the minimum threshold. So consecutively, she have to live outside UK for 5 complete years. If she returned to UK after no more than 3 years, the chargeable gain realized on the sale of the share would subject to CGT in the tax year in which she returns. So another point, the year of sale doesn't matter. When she returns, the year she returns, the gain will become chargeable. Any questions? Okay, my observation that you guys are pretty much interested in learning the topics rather than going with the flow of the question. Anyhow, we have to complete these questions as well, since it is a practice to pass session. Now, what does the second requirement say for us? It says liability of income tax in class 4 NIC contributions. Fairly a straightforward question based on 8 marks. And one thing again I would like to highlight here is that you have seen in the part A worth 13 marks. There were again among all the points, there were many points that were brought forward from the TX examination. So guys, if you are missing out on TX, please go back to the TX course contents, and you have to be very much clear about those rules, because everything here featuring is involving them, and you just cannot pass the exam by only practicing the technical areas of ATX exam. The TX exam and its application as per the scenario is required in your P6 examination. Okay, liability for income tax in class 4 NIC contribution. So we have seen that it says here a single set of accounts will be prepared for the 17th month period ending 31st October 2020. The budgeted tax adjusted profit for the period for this period before deduction of capital allowance is 94,000. So the profit is 94,000 and the capital allowances are not being calculated. So we have to calculate the capital allowances separately. The tax written down values on this day for the main pool is 0 and the car with the private use is 8700. So we have gone through the capital allowances as well, and we will see if we remember any rules of capital allowances now. Okay, on 31st October 2020, the plant and machinery used in her business excluding the motor car will have a market value of 6300. Fair enough. Every item will be sold for less than its cost, so it is very clear that balancing allowance will be arising here. Any problem in identifying the balancing allowance, Evelyn? It is very easy to identify the balancing allowance here. That's great. And the balancing allowance is actually increasing your expense, and it is favorable for the taxpayer. That's nice if you remember this. Okay. Freya Freya will withdraw a motor car from the business on 30th September 2020. The car has always been used 65% for the business purpose and will have the market value of 11,100, which is less than the car original cost. Again, we could see that it is less than the original cost of the car. Freya and FIM Limited will submit a succession election to HMRC. They are There are unrelieved overlap profits of 31,400. So can anybody please answer me what will be the treatment of overlap profits? We have discussed it in very much detail on the second session. In the second session, what will we be doing with? I have two questions for you people. What will we be doing with the overlap profits? This is the first question. The second question is how will we be apportioning the capital allowances for the cars in the private use? Anyone, if please want to answer. The answer to this question, it says liability of income tax in class 4 NIC contribution. For what are you saying? Overlap profits will be used up. Very nice, and the business cessation is ceasing in this case. That's very right. Very right, at the sham will be netted off. Okay, so we have been given some profits. We have calculated. I will be sharing the answer with you now, and we could easily see that it was a very straightforward calculation, and easy 8 marks were available. It has been mentioned that the trading profit for final 17 months is 94,000. Balancing charge on the sale of car is 1560. So if you could see, I have made this working for capital allowance. The main pool was 0. The additions were 4200. The private used car was worth 8700 at that particular time. It was disposed of 11,100, yielding a loss of 2400. 2400 balancing allowance results in 1560, and I have carried this up. The balancing charge, in fact, the you could see the written down value is 8700 and I am selling it for 11100. It is the balancing charge in this case, and the balancing charge will be limiting my capital allowances. The capital allowance is an expense. If it would be a balancing allowance, then I would be having an additional loss to claim. But if it is a balancing charge, it will be restricting my amount of the capital allowances. So I simply take the percentage of business and I'm taking it as positive. It is adding into my income. The overlap profits are being subtracted. Then the taxable total profits after being all these subtraction and addition will be 64,160. The personal allowance available in this case is 12,500. Since there is no need to calculate adjusted net income, the person is not exceeding 100,000 pounds. The person income is not exceeding adjusted net income of 100,000 pounds. So the taxable income in this case is 51,660. A fairly simple calculation for the application of the rates. This is the earned income, hence no application of nil rate bands of the saving income and dividend income is being applied. Simple rules are being applied: 20%, 7,500, and the rest 40%, 5,664. The income tax liability is total here. The NIC is applicable. The employer NIC applicable are class 2 and class 4 NIC. Here it class 4 NIC is calculated on the basis of these. I don't know why my computer is not cooperating with me today. I just wanted to highlight this for you. These are the taxable total profits on which I will be applying class 4 NIC. Class 4 NIC is applied like this: 9%, 9,500 on the zero rate band, 50,000 minus 9,500, 4136. I guess this calculation is wrong. 4,500 into 9%, 3,645. And the remaining goes to 283, and the total liability in this case will be the income tax liability plus the NIC liability. If there is any problem, please ask me in the question tab. Overlap profit will be used on the cessation of the business, and we only restrict capital allowance only to business use. Very rightly said. Okay, I believe this is very much clear. The last part is very simple in this case, and they were very easy marks to attain. The last part said, explain whether or not a gift of land by Alvaro to Freya at some time in next 12 months could result in a UK IHT liability. So the Alvaro was father of this lady, and the implications are being asked here. It is a fairly simple question. The gift of this land could not result in a UK inheritance tax if it were made while Alvaro is domiciled in Canada. This is because overseas assets owned by a non-UK domiciled individuals are not subject to UK IHT. This rule has already been under discussion in TX examination as well, and we are very much clear that a person who is not UK domiciled does not pay taxes in this way. It is fairly simple to say that the gift of land could not result in a UK IHT liability. However, if Alvaro will become deemed domicile in the UK on 6th April 2021, because he will then have been a resident in the UK for the next 15 years prior to the year of transfer. Accordingly, in order to ensure that no UK IHT liability can arise, Alvaro should give the land to Freya prior to 6th April 2021. If you go through the data of Alvaro, you could see his plans, and as per his plans, see, Freya's father Alvaro moved to UK and became UK resident on 6 April 2006. He is domiciled in Canada and has owned a plot of land there for many years. He is considering giving this land to Freya within next 12 months. I agreed to advise Freya on whether or not such gift could result in IHT liability for her. Alvaro is not well and is unlikely live for further 7 years. We should therefore assume all the potentially exempt transfer will become chargeable because Alvaro makes regular substantial lifetime gifts of assets situated in UK. We would assume there would be no nil rate band or annual exemption available in this case. So all this detail is helping us to know the possible answer, and that I have already explained. If there is any problem in this question, you can simply write in the question box. I can see, and we can move on to our next assignment. I believe you have gone through the question already, so there would not be much issues in it. So, should we start with the reliefs of capital gains tax first, or with the reliefs of inheritance tax? Let me open the handout for you. Okay, CGT. CGT it is. So we will be going for the reliefs of CGT. There are two kind of reliefs that are available for an individual. If a person is disposing of its principal private residence, the relief is available on that private residence, and that is not a business asset, and that relief is also not a business relief. Okay, I am going on with the CGT. So we need to have a clear demarcation that certain reliefs relate to the business mindset, and certain reliefs relate, not certain, just one, that is principal private residence, that relates to the non-business. The non-business asset reliefs are principal private residence along with the letting relief. These both make one relief. While the business asset relief, we have business asset disposal relief. That is the entrepreneur relief. That is the most important. We will be doing some questions and some discursive part of the withdrawal of investment from a company, where the application of entrepreneur relief becomes very critical and crucial for you people. Other than that, we have the rollover relief, we have the gift relief, we have the investor relief. Okay, so let's quickly go through the principal private resident relief. It is very much obvious that you have, I'll put up a scenario, and you could easily understand what I want to make. If a person is there, he has a single house for him, and the need of time is that he goes for a bigger house. In order to go for a bigger house, he sells out the previous house for some amount. If that some amount is subject to any CGT, after paying that CGT, the person will not be left with enough money to repurchase the same house he or she sold. So, if we tax the proceeds coming out from a principal private residence, we are actually encroaching the basic rights of those person who has worked a lot to make their house. So HMRC plays a very sensitive role here. They understand that making a house in this time of inflation and with this dynamic economy, it is very difficult, and they consider it for you people to give you relaxations on the disposal of the principal private residence. So if a person has a principal private residence and he is living there, the gain arising on its disposal will be exempted in proportion to the period of actual and deemed occupation. I will repeat myself. The gain, I'm highlighting it for you if you could follow me. The gain is wholly exempt where the owner has occupied whole of the residence throughout the period of his ownership. It means that if you were there all the time, all the gain will be exempt. But if you were not there all the time, then there are certain percentages, or then there will be a certain amount of the gain that will become chargeable. But having said that, the letting relief might become into play to save that for you, to save that amount to be taxed for you. When the occupation has been only for the part of period, the gain is calculated as gain on the disposal of property less PPR is equal to the chargeable gain. How you calculate PPR? The total gains multiplied by the period of occupation divided by the total period of ownership. So the time you were there divided by the time you owned the property multiplied by the total gain will be the amount of principal private residence relief. The amount of chargeable will be the total gain into the period of occupation divided by the total period of ownership. Now, we have said that the period of occupation is actually going to qualify me for the reliefs. So what the period of occupation will be? The period of occupation is pretty straightforward. This includes both actual and deemed occupation plus the last 9 months of the ownership without any condition. So this part I am highlighting it. This requires certain conditions to meet, that is the deemed occupation. The actual occupation and the last 9 months of the ownership, they are always exempt without any conditions. The last 9 months are exempt because changing or moving from one home to another, it is not a simple task. There are a lot of challenges in it. So HMRC has granted you the last 9 months of ownership as you were living there, either you were not living there actually or you were living there actually. So deemed occupation, for deemed occupation I've written it here. The period of deemed occupation must normally be preceded and followed by period of actual occupation. It means that before leaving the house, it says you were living actually in the house, then for some reason you left the house, and before selling it you came back to the house. So it is preceded and followed. Before leaving you were there, and once you're done with the thing outside the country or outside your home, you resume your residence back and then you sell it out. So the deemed occupation is followed is as follows, that up to the 3 years of absence for any reasons, you can go to any place, anywhere, for any reason, for the period of 3 years. These 3 years can be continued, or these 3 years can be in smaller parts. Plus, the second one is any period spent living overseas due to employment. For the overseas employment, there is no limit. You can go to any place outside UK for your work for any number of years. No restrictions for the time on that. But if you are being placed outside your hometown in any other place within the UK, there is a time limit of 4 years that you could remain absent. You could remain absent, but still being considered as deemed occupying the residence. When the individual owns more than one residence, then they can nominate one of them as their main residence, but the election must be made within 2 years of acquiring an additional residence. Otherwise, it is up to HMRC to decide, and usually HMRC decides in favor of the taxpayer. Where a house or part of it is wholly and exclusively for the business purpose, that part loses its principal private residence value and it becomes taxable. So for any portion that is not being in the private use, or that has been specifically used for the business purposes, it will not be qualifying for any relief under this relief, since it is based on the private use of your residence. I hope it is clear for you. Now, after understanding the actual occupation and the deemed occupation, we say that, I go back to this portion. We say that there was some gain on the disposal of property, and for example, the gain was 60,000. And I say that PPR in this case, I got 45,000, and by actual occupation and by deemed occupation, and the chargeable gain in this case becomes 15,000. Now it says for the chargeable gain amount, if you are outside. So one thing is for sure, this chargeable gain is arising because of period of absence. So the period that is neither covered under actual occupation, neither covered under the deemed occupation rule. So this is because of the period of absence. In the period of absence, if you do not close your premises, but instead of closing it, you let it out, the letting relief applies. This applies if the owner lets out the property, part of the property, and lives in remainder. But if the owner has one lodger who lives as a part of family, then this relief is not considered. In this case, you have to understand that you are giving your premises to someone on rent basis. You are letting it out, and you are not letting it out as a paying, as simply a guest. Letting relief only applies to the owner main residence, which is lower of 40,000, the amount of gain exempted under PPR rules, and the amount of gain still in charge. In the previous above example, if you could see, 45,000 was charged under 45,000 was exempt through PPR provisions. Chargeable amount was 50,000, and the pre-calculated fixed amount by HMRC was 40,000. In this case, 15,000 will be qualifying for letting relief. I hope this is clear for you. If there is any problem, you are free to please ask. Let me just open the question tab and we'll see if there are any questions popped out. Yes, regarding letting relief or principal private residence relief, if there is any question, please come up with it so that I can move on to the entrepreneur relief. Is Ravi there today? So Ravi is not here today. Okay. So the question is regarding letting relief, understand that there has been a change where if you, the owner, is not in the house and away, perhaps working abroad. Look, if you are working abroad, then you are can you claim letting relief? Okay, let me put this up for you, Claire. If you are working abroad, you will be covered under deemed occupation. Letting relief plays a critical role where you are not either covered by actual occupation or deemed occupation. So, due to some reason, you have exhausted the deemed occupation things. For example, uh, you could have lived in Scotland outside your own hometown, that might have been London, and you have spent more than 4 years there. Now, for the 4 years, it is qualifying under deemed occupation. There is no letting relief. The letting relief is not going to yield you any additional benefit. But for the time more than 4 years, where the actual and the deemed occupation is not covering you, the letting relief can actually cover you. So the letting relief is benefiting you where you're not covered by actual and deemed occupation. Evelyn, is it clear now? Okay, great. Now we are going to talk about the most relevant and the most applicable relief of CGT, that is entrepreneur relief. From TX course contents, this is the most important and critical relief that has been brought forward, and the technical implication and application of this relief is very much examined, specifically in case of corporation tax, withdrawal of investment, and many tax planning scenarios are purely based upon the application of entrepreneur relief. The letting is not available during the period of action. So, so in the very first session, we have seen the question in which we were okay, Tommy. Let me just confirm you. It is available. I'll give you the reference now. Okay. The question we were attempting there, the examiner has specifically mentioned that the application of entrepreneur relief in the withdrawal of investment was the critical part that major students missed out. I hope you remember that. So the application of entrepreneur relief is very much critical here. Let's just start this. This relief applies on the first 1 million of gains on qualifying business disposals, that is at the rate of 10%, charge on any gains above 1 million are taxed at the normal rate. So it is a very simple thing. If there is an entrepreneur and entrepreneur is disposing of its business assets, and they are not covered by any other relief, one relief is always going to cover it up. That is the entrepreneur relief. The entrepreneur relief is not going to roll over. The entrepreneur relief is not going to simply multiply 0%, but what it will be doing it will be taxing your gains at a discounted rate of 10%. Once the lifetime limit is exhausted, the remainder gains will be taxed at the normal rate, that is 20% in case of assets other than the residential property. And this limit is being exhausted by every gain that qualifies for entrepreneur relief. Gains qualifying for entrepreneur relief are set against any unused basic rate band before the non-qualifying gains. So we know that the unused basic rate band qualifies for the 10% basic rate of entrepreneur relief. Is it so? Do you remember? Do you know the application of CGT rates? How do we apply them normally? 10% basic rate, okay, for the unused basic rate band, definitely. And when that basic rate band is exhausted, you are on the higher rate. Now, if you could try to understand what I want to make my point here is, if there are gains qualifying for BADR, that is the entrepreneur relief, the benefit here of 10% basic rate is being consumed. HMRC says that I'm already giving you a discounted rate of tax. So that very relief that was originally given by multiplying 10% on the unused basic rate band is being withdrawn. And the gains qualifying for BADR will actually consume that unused basic rate band on priority. I hope this is clear. And the BADR is calculated after allowable losses at AEA. You could see that the ER rate, the entrepreneur relief rate is 10%, while the normal rate is, means we use unused nil band, then unused nil band will not be longer. Yes, yes. While the normal rate is 20%. Now you could see that if I use my allowable losses and annual exemption against the gains qualifying for 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 the gains qualifying for ER, I will be saving tax on 10%. But if I use my allowable losses and annual exemption against gains not qualifying for ER, I will be saving tax at 20%. So this is a tricky part. You have to understand that any allowable losses and annual exemption is to be netted off against the gains not qualifying for ER, because it will give you an enhanced tax saving. If you match it with those qualifying for ER, you will be only saving 10%. That is not being beneficial. And as far as Ihtisham has mentioned, it is right. The unused basic rate band that could have benefited you is actually exhausted by the number of gains qualifying for ER. If I could do a question for you here, I say gains, I say unused basic rate is 15,000, gains qualifying are 20,000. Okay, I say it, gains qualifying are 12,000. Gains not qualifying are 10,000. Now, if I sort out this question, you could easily see if I ignore gains qualifying for ER and if I combine both the gains, 22,000 of the gains, I could simply say 15,000 out of 22 could be taxed at 10% of the basic rate and the rest will be taxed at 20%. But I have gone through this rule and I know how to apply it. I will simply be saying that unused basic rate band will be consumed by the gains qualifying for ER on priority. So by sorting this question out, what I will be doing is these gains qualifying for 12,000, they will be multiplying with 10%. This is ER, the rate of entrepreneur relief. Now the unused basic rate band was 15,000. These gains qualifying for 12 for ER, which were 12,000, they have consumed it, and now we are left with 3,000 of the unused basic rate band. The next thing, we are going to tax these 10,000 of the gains not qualifying for ER. 3,000 unused will be using 10% again, and that is the normal basic rate, and the rest 7,000 multiplied by 20% higher rate. I hope this is clear for you guys now. Any problem? Make sense? Okay, I can explain it again. We have total unused basic rate band of 15,000. We have gains qualifying for ER 12,000. Gains not qualifying for ER are 10,000. Now I am applying CGT on them, and by applying CGT, when I have gains qualifying for ER and I have gains not qualifying for ER, I have to tax gains qualifying for ER on priority so that they could consume unused basic rate band on priority. So there were gains 12,000. 12,000 of gains qualifying for ER will consume this 12,000 out of 15,000 of the unused basic rate band, and I have done this 10% ER rate. Then rest of these 10,000 gains qualifying not qualifying for ER will consume 3,000 of the unused basic rate band left from those gains that qualified for ER. 10% of the normal rate has been applied on this, and the rest of the gains not qualifying 7,000 are taxed at the higher rate of 20%. Bilal, I hope it is clear now. This relief must be claimed within 12 months. That's fine. Good. The relief must be claimed within 12 months of 31st January following the end of the tax year in which disposal is made. The most important and the tricky part in ER, apart from its application, is the conditions that make a disposal qualify for ER. You have to understand that qualifying disposals are all or part of sole trader or partnership business, asset or sole trader / partnership business after cessation, shares in an individual personal trading company and the individual is a full-time or part-time employee. Personal trading company says where you have shares more than 5%, in excess of 5% ordinary share capital. If these qualifying conditions are met, you qualify for ER, but if these are not met, ER is not basically applicable. In case of, basically, we could simply divide the material disposals into two categories, one of shares and the other is other than shares. In case of disposal of the whole business or share, they must be owned for at least 2 years prior to disposal, while if the business has been seized, I hope, guys, the screen is clear. Okay. Okay. If in the case of disposal of whole business or shares, they must be owned for at least 2 years prior to disposal. And if the business has ceased, the trading asset must be owned at least 2 years prior, and disposal must take place within 3 years. Within 3 years implicate it could be before or after, but both the dates come within the period of 3 years. So any problems in the entrepreneur relief? Sorry, I wanted to open the questions. Shop was owned for 8 years by individual for some business as restaurant and sold for 40K to unconnected person, not as a going concern. Any relief or non-apply? CGT treatment, please. Okay, so this is a shop that has been owned for 8 years by individual, and he has been doing some business and it has been sold for 40K. So ER can easily be applied here. Yes. Replacement of business asset relief. Okay, Jawad, if you want me to elaborate it more, I can share some facts with you. Okay, great. Disposal of assets on which ER claim must be sold within 3 years after the cessation of business. Basically, Ihtisham, it is like the disposal and the cessation should be within 3 years. So, if you have ever done the business or if you have ever disposed of anything, you know that you do not dispose of things on the run time. You might dispose of some things prior to cessation, or you might dispose of some things after cessation. So you have the grace period of 3 years before and after the date of cessation, so that it could help the taxpayer in some better way. I hope it's clear. Now, replacement of business asset relief, it is the most relevant relief, and it is oftenly causing a lot of trouble for the students. The pattern of the question for these reliefs is the the examiner takes you on historical basis where the base costs have already been calculated. You have to rework your question, and there the concept of rollover relief is being tested. What is rollover relief? It says that relief allows the gain arising on the disposal of assets to be rolled over only if the proceeds are reinvested in a new qualifying business asset. So consider the case where consider a case where business is selling out some asset, and there after selling that asset some cash is being entering in the business. That cash is not left idle. That cash is again being invested in bringing the new qualifying business asset. Now if the cash is not being reinvested in bringing a qualifying business asset, the whole amount of the gain will be chargeable. There will be nothing rolled over, but the proceeds are being reinvested in the qualifying business asset, then the gain can be rolled over. The trick here is simply understand the amount being used qualifies for the gain being rolled over. The amount not being used will realize the gain immediately. I hope it is clear. I will explain it again. The amount of the proceeds that you utilize in purchasing the new qualifying business asset will lead to the rollover of the gains, but the amount you have not reinvested, that remains idle with you, that remains in your pocket, it will give rise to the chargeable gains immediately. Okay, no questions till now. Qualifying business assets, it has depreciating asset and non-depreciating assets. Non-depreciating assets are goodwill, land and building, fixed plant and machinery. Depreciating assets are fixed plant and machinery, leasehold property with 60 years remaining on the lease. So see, you could reinvest or you can dispose of any of your non-depreciating or depreciating asset. But the significance of being depreciating or non-depreciating is more of when you are talking about the reinvested asset. The asset being purchased by the asset is much of the concern here when we talk about was it a depreciating asset or was it not a depreciating asset. So let me explain this in detail. When we opt to reinvestment the money into the non-depreciating asset, the gain from the disposal of the asset is deducted from the acquisition cost of the new asset and reduces its base cost. Okay, let me take an example out here for you. I say that sale proceeds were 10,000. Let's have it at 15,000. The cost was 12,000 and I am having a resulting gain at 3,000. I hope everyone is clear till here. It says that the replacement asset cost is 20,000. Now what we have to compare? We have to compare the selling proceeds with that of the replacement assets cost. So you could see you had you received 15,000 out of that sale, and when you bought up the replacement asset you actually paid 20,000. So the cash you already had is also leaving your business. In this case you are left with no new cash without being taxed. So in this case whole of the proceeds are being reinvested, so the gain, all the gain will be deferred or rolled over. I will be deferring it. Gain chargeable will be nil. So the amount, but you have to understand that gain is rolled over. It is not being exempted. It is rolled over for the period, and the amount of the rollover is actually being deducted from the replacement asset cost. The amount rolled over is 3,000. So the base cost of the new asset will be 17,000. In future, if I say that I'm going to sell this replacement asset at, for instance, 25,000, the original cost was 20,000. So the gain should in this case be, the actual gain that should arise have been 5,000. But considering the base cost, when I subtract the base cost out of it, I get the gain equivalent to 8,000. This 8,000 is the 5,000 pertaining to the replacement asset plus 3,000 pertaining to the asset I actually have rolled over. So this is how this working is based upon. If the proceeds are reinvested fully, whole amount of the gain is rolled over. The amount being rolled over is deducted from the replacement asset market value, and its base cost is being calculated. When in future we dispose of that replacement asset, the gain that has been rolled over becomes chargeable. One point here is of very prime importance. It says if we are we are reinvesting into a non-depreciating asset. For example, it's a land or building, and if we do not dispose of that land or building in our lifetime, that gain will remain rolled over until and unless we dispose that replacement asset. So it is very much obvious that the non-depreciating asset could actually lead us to roll over the gain until many years if we are not disposing of that land and building. Now, the other way around is I say I am not rewriting the question, I'm just doing it. Now the replacement asset cost I am taking as 12 14,000. You could see the selling proceeds were 15,000 and replacement asset cost is now 14,000. In this case, what I will do? Can anybody tell me? Gain is 3,000. There is no problem till now. I could open the questions. Got it. No questions here. Okay. So the gain is 3,000. Nothing changes till now. We say that sale proceeds were 15,000 and the replacement asset was worth 14,000. Now we could see simply 1,000 out of these sale proceeds is not being reinvested. It says not a problem. What you will do is the amount not reinvested here will become chargeable immediately. The amount not reinvested becomes chargeable. So out of 3,000 gain, 1,000 will become chargeable and rest of the 2,000 will be rolled over. I could say that this is the balancing figure. And the amount being rolled over, it is deducted from the market value of the replacement asset and its base cost is calculated. In this case, the base cost will become 12,000. In future, we will be selling out this asset for 12,000. So the original gain of the replacement asset plus these 2,000 that have been rolled over from the previous asset will also become chargeable. But if I do not dispose of my non-depreciating asset, none of the gain will become chargeable. The gain, I have written it for you as well so that if there is any problem, the gain can be rolled over until a disposal is made and no replacement asset is purchased. Deferred gain is crystallized and it is taxed on the CGT rate. In case of partial reinvestment, the gain is chargeable roll off, uninvested proceeds, full gain, etc. This is elaborated by the example. If there is any problem, you are rollover relief will be 2,000 and 1,000 will be chargeable. Very nice, Atisham. Thank you very much for adding to it. The claim has to be made within 4 years. So this. The qualifying condition is that the replacement asset should be purchased 1 year before or 3 years after the disposal of the old assets. Both the assets should be used in the business immediately, and only the business assets qualify for this. No asset other than the business asset could qualify for this relief. This was the case with the non-depreciating asset. In case we have a depreciating asset, then what do? We do all the same steps that the amount not being reinvested yields to the chargeable gain immediately. If the whole proceeds are reinvested, no gain is chargeable. But in case of depreciating asset, the gain is frozen until the earlier of. The gain is frozen until the earlier of the date when the replacement asset is being disposed of. When we dispose of the replacement asset, we need to look at the earlier of the date when the replacement asset is ceased to be trade. We are not disposing it off, but it is no more playing any part in the trade, and 10 years after the purchase of the replacement asset. And maximum time we have got is 10 years. If we are not seizing, we are not disposing it In 10 years, it will naturally become chargeable once 10 years of the frozen period are complete. If there is any question, please ask me. But Evelyn, you say so you need to reinvest into an asset that is equal or more than sale proceeds. Yes, for the planning point of view, if you have given the choices, you say that the business should reinvest should reinvest whole of the proceeds. But if the if we do reinvestment in such a way that if any gain becomes chargeable and it is covered under or annual exemption, we could simply go for that. That is not a problem. But you have to see that what is the scenario and how things are being phased out. Now, one thing here is left for the rollover relief if there is a private use. We have seen that the business and the private use is very critical. If there is private use, we have seen there are certain businesses where got it, thanks. Great. I'm happy that you understood it. There are many scenarios where there is a private use in the business premises. For example, there is a building that is being used for the business, but 10% of it is under your private accommodation, and you are using it for your private use. So all these reliefs are for the business assets. You cannot simply use these reliefs for the portion that is for the private use. In this case, if there is a private use, what you will be doing is you have to treat the asset as it if they were two different assets. For instance, I say the asset was costing 200,000. Sorry, the asset was sold out at 200,000 and the cost was 100,000. And we say that in this case, the split was business 75%, private 25%. So now what I will be doing is I will be doing it in such a way that I have two different assets. So one will be 200 into 75%, that will be 150,000. This is the business asset. The rest will be 50,000. That is the private asset. Okay. The cost is 100,000. 75,000 will be for the business asset. 25,000 will be for the non-business asset. Now you could see that I have the resulting gain here is 75,000. Now this 75,000 will be tested again if the proceeds of 150,000 are being reinvested or not. But the gain arising here, that is 25,000, this will be chargeable immediately. And if I say that the asset I am bringing, so I'm talking about the assets in which I have reinvested my proceed. If it has some private use, then again I will be treating it as two different assets, and I will only be comparing this business portion with the business portion of the asset coming in. Any problems? If there is any problem, please tell me. And I guess the session is getting longer without any breaks. It is time 5 already, and gift relief is missing. Only we could easily cover it, and then we could move on to APR and BPR, and we will be attempting the question as well. So guys, let's have a break of 15-20 minutes, and we will be back in good 15-20 minutes. If there are any problems, I am here in next 2 minutes. You could please ask your questions in next 2 minutes relating to this. I will be addressing your queries. If there are no questions in this, in the break time, you will see if there are any questions, you can just write them out. I will be sorting them out for you. Can we multiply 75% to the gain for business purpose? No, Itishan. No, we cannot do that. We have to do it systematically. Okay, guys, let's have a break. We'll catch up with you in next 20 minutes. Okay, guys, welcome back. I hope the contents we covered are clear to you. If there are any queries, you are more than welcome to put up in the question tab. I will be very happy answering them. Now we will be moving on to our gift relief. Gift relief has to be understood because this relief is interacting with the IHT reliefs, and in multi-text scenario questions, the interaction of these relief of the gift relief with those of the IHT reliefs is pretty much critical. And though the students who are comfortable with this are capable of scoring good marks, and those who are not comfortable with this fail to score good marks. So this is a technical area that you need to concentrate on, and you can only be comfortable using these reliefs when you know the basis, as when this particular relief is going to apply and how this particular relief applies. If you are clear on that, then there is only one problem left, that you have to apply it on the scenario, on the given scenario. But if you're not clear on the basis of the relief, you cannot apply it on the scenario, and if you do apply it, you do not actually fetch those results that are desired. So what when the gift relief applies? Gift relief basically allows the gain arising on the gift of qualifying business asset to be held over until the asset is eventually sold by the donee. When the gift relief occurs, basically there is a donor and a donee. Donor is making a gift to the donee, and in different questions we have gone through, the person was unconnected. Why we were given that information? Because when the person is connected, we somehow might add the component of the gift in it. So for the connected person, when it is written that the person is connected, it may be your nephew, it may be someone from your family, it means that there is some chances of gift relief being applied, or you might be gifting some asset to a person. So the important thing here is if it is connected, so there will be the application of gift relief. There is a donor and there is a donee. The simple rules, I will be elaborating it again, but you have to understand the simple rules here is either you are receiving consideration or no consideration. You are making a gift and the gift is against some consideration, or it is against no consideration. For consideration, we have 2 points. Number one, zero value received, and the other one is value received but less than market value and cost. For instance, if I say that an asset whose market value is 10,000, whose cost is 8,000. Now you say that you are gifting this asset for no consideration. It means zero value received. You call it an outright gift. But if you say that you have received some consideration and that consideration is equal to 6,000, consideration received is 6,000. Now you could see that this 6,000 is less than the original cost, less than the market value. Hence, you are gifting some real gift. So the HMRC says when such is the scenario, we consider it as a outright gift, and the treatment of the outright gift I will be telling you uh, in a while. But the other case can be if you take the consideration as 12,000 as 9,000. Now you could see the person who is receiving the gift from you for equal to 9,000 can get this thing from the market at 10,000, and you got this thing at 8,000. By accepting consideration of 9,000, for you are receiving 1,000 more than the actual cost, but the person is still having a gift equal to 1,000 because he's getting a thing cheaper than the market value from you. Now, while moving towards the calculation, we need to understand that there are two computations. When shares are being sold, we have different criteria to apply with on gift relief. When the assets other than shares are sold, we have a different criteria. So these scenarios I have explained, they apply where the assets other than shares and securities are sold. In case it is an outright gift, I have mentioned if it is an outright gift, all the gain will be deferred. Now you could see I say if it is an outright gift, and outright gift is under two conditions. Number one, you are not receiving any consideration at all. Number two, you are receiving consideration, but the consideration is less than the market value and the cost. So in that case, all the gain will be deferred. Now, the first scenario I have written over here is the market value is 10,000, the cost is 8,000, you have received consideration equal to 6,000. If you revisit the rules that you know about CGT of chargeable disposals, we have understood what a chargeable disposal is. We have mentioned that a chargeable disposal includes gift of asset or part of asset, and this particular rule has elaborated as we always take the sale proceeds equal to market value. In this specific case, you have received no consideration, but for working for donor, what you will be doing will be your sale proceeds will be 10,000, that is the market value. Your cost here is 8,000. Your resulting gain is 2,000. But it says since it is an outright gift, deferral will be equal to the gain deferred will be equal to 2,000, and the amount chargeable will be nil. I hope this is clear. And for donee, the donee inherits the asset. So sorry, the donee gets this asset at the market value. The market value is 10,000. The amount deferred is deducted from here to calculate the base cost, that is 8,000. Now in future when the donee will sell this amount, will be selling at the base cost of 8,000, the amount deferred plus the new gain will arise, and the donee will be paying the tax that was originally has to be paid by the donor. So in the gift relief, it is pretty much necessary for both of them to agree on this, because the donor, because the donee will be paying the tax that would primarily have been the responsibility of the donor. I hope this is clear. Now, if it is not an outright gift, what will happen? I will be moving on this same example that I have told. The consideration is 9,000. So if the consideration is 9,000, again, the trick is the same. You have to see amount more than original cost will be chargeable immediately. So in this case, you could see that the gain, the selling proceeds are 10,000. Again, the cost remains 8,000. There is no change to that. The only change is to the consideration, and consideration has nothing to do with this. The gain is 2,000. Now, among the 2,000 gains, the amount more than the original cost is 8,000, and you have received consideration equal to 9,000. So the amount chargeable in this case will be 1,000, and here 1,000 will be deferred, and this will be your balancing figure. I hope this is clear. So the chargeable amount is directly calculated through looking at the consideration that is more than the cost. This implicates the value of cash that is coming in your pocket without being taxed. I hope this is clear. If there is any question, please ask. Evelyn, are you there? It's clear? Ehtisham, Evelyn, Jawad, the guys who were very active throughout these webinar days. If it is clear, I could move further. Okay, now I'll just quickly wind it up. Gift relief allows the gain arising on the gift qualifying business asset to be held over until the asset is eventually sold by the donee. When the donee sells it off, the gain of the donor will become chargeable on donee. It is available on the qualifying business asset and gifts by the individual water. Then for the donor, normal capital computation is made. The gain is deferred against the base cost acquired by the donee. And for the donee, acquisition cost is the market value at the time of gift. Base cost is acquisition cost less any gain deferred by the donor. I have shown you through the example, and I think it is very much clear to you guys. If the donee sells the asset, this is all that has been explained. The thing I need to explain further is the qualifying asset. If the asset is used by the donor in his business, then it is a qualifying asset for gift relief. If the asset is used by the company and the company is the personal company of the donor, and the company is a personal company when you have more than 5% of his ordinary shareholding, these are for the assets other than shares and securities. For shares and securities, if it is an unquoted company, unconditionally the shares and securities of an unquoted company qualify for gift relief, but the shares and securities, if featured through a quoted company, it should be a personal company to qualify for being a qualifying asset for the gift relief. And the personal company is a company where you own more than 5% of the personal shares, ordinary share capital. Okay, so we are done with the treatment of gift relief for the assets other than shares and securities. This is what I have already explained to you. And for shares and securities, we have simple formula being shared with us. We calculate the gain. Gain is calculated simply by deducting the cost from the sale proceeds, and we multiply the gain with the market value of the chargeable business asset divided by market value of the chargeable assets. Now you have to understand that the gift relief is equivalent to the chargeable business asset market value divided by the market value of the chargeable assets. What is an asset that is chargeable? That when I will sell it off, it will either give rise to a chargeable gain or an allowable loss. And what is a business asset? The asset that is primarily used in the core activities of the business. When we say the divisor, we analyze the divisor market value of the chargeable asset. It includes the chargeable business assets plus the chargeable non-business assets. The definition of the chargeable remains same, that when we sell them off, it gives rise to a chargeable gain or a chargeable loss. And a chargeable non-business asset is an asset that is primarily the investment of your business outside your business. So when the examiner says the investment, we say that my business is investing. If my business is investing on the activities of my business, the examiner will not be using such words for you. The examiner will straight away say the business brought the trading assets. The business brought the assets used for the business. They are the business assets. But when the examiner says the investments, the investment will be definitely out of the business. There will be the money of the business. They will be from the finances of the business, but invested outside the business. So we will be analyzing our balance sheet extract in order to get this. One mistake that the students commit, you know that the chargeable assets belong to the capital category, and that capital category is found in which financial statements? That is statement of financial position, we call balance sheet. In balance sheet, we when we analyze the assets, we have non-current assets and current assets. The current assets are not going to be part of this calculations. The examiner often gives you the amount of your items that are used to calculate the cost of sales in the income statement. The impact is reflected in the income statement, hence we are not going to use any of that stuff for this calculation. You have to simply ignore the value of cash, you have to simply ignore the value of receivables, you have to simply ignore the value of the stock. I hope this is clear. Okay guys, I hope this is clear. If there is any problem relating to this, you can please write in the questions tab. I will be giving you 2 minutes so that we can conclude this and we could move on to the reliefs of inheritance tax. Before moving on to the reliefs of inheritance tax, if there is any other topic or any other area of capital gains tax or income tax you want me to enlighten, I will be very happy doing that for you. For tomorrow's agenda, I have selected one question of income. I have selected one question relating to IHT and CGT that we will be doing in the first half. Plus, we can do any two topics plus one question of corporation tax as per your desire. So you are more than welcome to write in the questions tab so that I can prepare myself for the upcoming session. That will be our last session. This is a question that we will be doing, Akhil, and now we will be doing okay guys, no question. This is very strange. I want you to please raise some questions. That method has to be closed. We've done this. Let's do it first. No, Ravi, we will cover it tomorrow. I would, okay. NIC is quite simple, Ravi. Okay, but I'm noting the topics. Can you quickly de minimis limit? Okay, okay. De minimis limits of VAT. Apart from de minimis limit, anything else to be discussed from VAT? Okay. So tomorrow's agenda will be we will be discussing value added tax, specifically the de minimis limits. And if somebody has some queries regarding partial exemption, so we could also go through that, plus a little light on NICs and share schemes as well. These are the three things I have noted for tomorrow's session, plus anything from corporation tax to be discussed. I will be very happy doing that. Now we will be moving on to the business property relief of IHT. Can I move on? Okay. So what is a business property relief? You know that when IHT applies and how we are applying IHT, the rate of application of IHT is at 40%. You know that it is quite a handsome rate, and every single person will try to adjust their properties in any reliefs that are being available. Business property relief is potentially one of the key reliefs that is available, and these reliefs are enabling the taxpayers to save handsome amount. I guess we missed out on investors relief. Okay, once I wind it up, I will quickly go through that. There is nothing in investor relief. There are some dates to remember and a simple 10% rate. No worries at all. I will go through it. No worries at all. Okay. So what the business property relief is? It is available on the worldwide relevant business property. Number one is, what is worldwide? Assets pertaining to your name, either in UK or outside UK. They are worldwide. Relevant. If they are somehow being used in the business, directly or indirectly assisting your business property, your business activities, they will be your relevant business property. Sure, Tommy. It is available on both the lifetime and death transfers, but deducted before any other exemptions and relief. Now, when we apply the reliefs in IHT, we need to ensure that there are some specific reliefs and there are some general reliefs. Some general reliefs are like annual exemption. We do not use annual exemption on priority to these reliefs. Specific reliefs are dealt on priority. Once they are once they are being dealt with, then we move on to the general reliefs. Okay, what is relevant business property? I have explained it a little, but in detail, we say that relevant business property can be an unincorporated business or interest in partnership. Simply, you are the owner of your unincorporated business, or you are working in a partnership, and the interest of yours in that partnership, maybe you're 50% partner, maybe you're 70% partner. That is the relevant business property for you. If it is unquoted securities of controlling company before gift, control may be achieved by taking into the account of the related property. Obviously, you know the related. I assume that the related property rules are clear. So unquoted securities of a controlling company before gift. You have not made the gift. It's your controlling company, and the securities that are present in that will be the relevant business property. Unquoted, that is securities. Unquoted shares of any company, that also qualifies. Quoted shares and securities for the controlling company before gift, control may be achieved. Again, the same thing applies. If it is quoted, then shares and securities of the controlling company. Any land or building, machinery or plant which immediately before the transfer was used wholly or mainly for the controlling company or partnership in which the transfer is a partner. What does it mean? It means that if it is a land, if it is a building, if it is a machinery, if it is a plant, before the transfer was completely or mainly used by that company or partnership in which the partner is the transfer. BPR percentage is 100% of the assets within A, B, and C, and 50% of the assets in D and E. A, B, and C is unincorporated business and interest in partnership, unquoted shares and securities, and quoted shares and any unquoted shares of any company. But for quoted shares and for any land and building, it is 50%. I hope this is clear. I could just see the question box. No questions. Okay, I move on. BPR is not available on the gift of investment business dealing with securities, stock, and shares, or dealing in land and building or investment assets. We said that BPR is available for the relevant business properties. The investment businesses are not the cup of tea here. We will not be entertaining any investment business in case of BPR. BPR on shares is calculated. You calculate the transfer of value. What is transfer of value? Can anybody tell me in the dialog box? Transfer of value into trading assets divided by total assets into the relevant BPR percentage, and we get the BPR relief. I am looking for the question box. Who could tell me what is the transfer of value? I guess we have talked about it in our second session. If not, you are close to the examination and I believe you have some knowledge of that, please. Okay, what is transfer of value? Transfer of value for IHD, we do not use the simple value of the gift. We actually calculate the value of state of the donor before gift, and we subtract the value of the donor after value of the state of the donor after gift. The difference between both these values is actually your transfer of value. So we do not look at the real gift being given to the donee. It may be not significant, but if we look at that impact it has created for the state of the donor, it might be very much more than that for the donee. So we consider it as transfer of value concept, and the amount comes from that difference. Okay. For BPR to apply, there is a minimum period of ownership condition. Asset being transferred must be retained for a period of 2 years. If the asset was inherited on the death of the spouse or a civil partner, the couple's combined ownership should be more than 2 years. So the basic criteria is the period of 2 years, and when you are a couple or you are a couple in form of a spouse or civil partner, you have seen that in case of civil partners and spouses, we have considered no gain, no loss, and even in the group of companies, we have seen that in the group of companies, the group of chargeable gains, we have seen that there is no gain, no loss kind of transaction between the group of companies as well. Is it so? Evelyn, Ravi, Bilal, Tommy, are you there? Getting my point? All clear, great. If the existing business property is replaced by the relevant business property, then combined period of ownership should be, sorry, can you repeat? Yes, please. Okay, what point you want me to repeat, Ravi? I explained the transfer of value, and then I was explaining the impact of a spouse or civil partner. Asset transfer. Yeah, the asset transfer I was talking about. In case of spouse and civil partner, just asking. Okay. Okay. Great, Tommy. Great. Okay. So we have seen this relevant rule in no gain, no loss transfer in CGT, where a spouse transfers any assets to the other spouse or civil partner on no gain, no loss. And similarly, in case of group of companies, the group of chargeable gains, one company transfers to another group company the assets at no gain, no loss. And in this case, we are not talking about any gain or loss, but we are talking about if the assets, we have to satisfy the basic time period of 2 years, and if a spouse has gifted anything to the other surviving spouse, and it was owned by you for 16 months, and the gifting spouse has owned it for 8 months, 16 plus 8 will be considered as 24. So this will clearly be meeting the basic threshold of the minimum time. So combined time period could be considered here if the existing, I hope it is clear now, Ravi, if the existing business property is replaced by the relevant business property, then combined period of ownership should be at least 2 years out of the last 5 years. BPR is given on the lower of the two property rule. Basically, there was one asset you were using, somehow you wanted to replace it with a better version. So one asset has been with you for good 19 months, you replaced it, and the other asset is now for further 10 months. So when you combine 10 plus 9, it is more than 24 months. So out of the last 5 years, if this combined period is more than 24 months, then this still qualifies for BPR by qualifying the minimum period of ownership. I hope it is clear. Successive transfer, no need to consider ownership period for BPR if the following conditions are fulfilled. The property being transferred were inherited and first donor qualified for BPR. When the donor was originally qualifying for BPR and then the property has been transferred to you, you do not need to go for this minimum period ownership as it has already been met. The number two, and any of the two, either the property was transferred due to death of the first owner or the property is now chargeable due to the death of the second owner. In these cases, you do not need to fulfill the minimum threshold of the ownership. Apart from these, you have to fulfill that minimum criteria. Okay. Withdrawal of BPR happens when it happens when the relevant business property is not used for the business purposes at the date of the death of the donor. When the death of the donor occurs, we reassess that the conditions of BPR that met earlier are still in place or not. So GCA will be, I read somewhere that BPR cannot be more than the original transfer. That is the two property rule, yes. Yeah, that is the two property rule. The original value remains the limiter. That remains the showstopper. You are right, Tommy. So the relevant business property is not used for the business purpose at the death of the donor. When the donor dies, you have to see that the relevant business property that was relevant at that time is still relevant and used by the business or not. If it is not used, then we have to withdraw the BPR. The second condition here is the business property has been sold by the donee. The donee who received that business property has sold before the date of the death of donor, and replacement business property was not purchased. So if I could develop a workaround for the B point that the business property is sold by the donee before the date of death of donor and replacement property was there, then we consider that BPR is still available. But if no replacement property was purchased, we consider that the BPR has to be withdrawn. So This is the summarized version of BPR, and it covers everything of it. And I believe this is clear to you guys. Then we move on to agricultural value. If there is a problem again, if there is problem in relevant to the accepted assets, the point I mentioned here is the BPR is equal to the transfer of value into the trading assets divided by total assets into the BPR. If there are accepted assets are those assets that are not primarily used in the business, that are not relevant to the business. So what we will do is we will be eliminating them out. BPR is available only on the relevant business properties. Okay. Any problem? Bingo. I guess there is no problem. Agricultural property relief is more of a same kind of relief as BPR, but there are certain changes in its dynamics. Again, like BPR, APR is also automatic relief on properties. It is an automatic relief on property situated in UK, EEA, Channel Islands, or the Isle of Man, and can reduce the transfer of value property by 50% or by 100%. There are some cases in which it's your own land being used by yourself, or in some cases it is used by your tenant. So the rate of agricultural property relief is dependent upon that. In some cases it is 50%, in some cases it is 100%. It is available on the properties available in UK, EEA, Channel Islands, and Isle of Man. It is available on, again, like BPR, available on both lifetime and death transfer, but deducted before any other exemptions, because these are the specific reliefs. APR, BPR, triple relief, they are all specific reliefs and they have to be used in priority then the general reliefs. Okay, moving on, it is available upon the agricultural value of the agricultural property if it is held for the minimum period of ownership. Before moving on to the minimum period of ownership, I need to elaborate this concept of agricultural value of the agricultural property. We say that it is an APR. The relief is based upon that particular component of the land that belongs to that agricultural value. Any land has two kind of values. If it has been used for the farming thing, it is the agricultural value. But if we start using it for the commercial purposes, commercial basis, it can be its developmental value. So we are not going to allocate any APR on the developmental value or the commercial value of the property. We will be specifically concerned with the agricultural value of that property under discussion. Any problems? Agricultural property includes farmland, farm building, farmhouses, milking parlors, pastures, and cottages. Agricultural value, the value of property because of the agricultural capacity, is called the agricultural value. I've explained it. What is the minimum limit for this? If the if it is owner managed, and minimum ownership period will then be 2 years, and 100% APR will be applicable. If the owner is managing its own property, then the minimum ownership period is for 2 years and 100% APR will be granted. If the agricultural property is under the tenantship and the ownership period is minimum 7 years, which was 2 years in case of being owner managed. If being tenanted, the ownership period is moved to 7 years, and let before 1995, then 50% PPR will be available. So for the tenanted, these conditions change and the rate of relief available is also changed. 50% APR will be available. Okay. If the agricultural property is under tenantship and the ownership period is minimum 7 years and let after 1st September 1995, that was before 1995. after 1995. If before 1995, it is 50%, and if it is after 1995, it is 100%. If the donor has inherited property on the death of the spouse, the combined period of ownership of both the spouses should be greater than minimum ownership period. Again, we have elaborated this point, no need to elaborate it again. If the existing agricultural property has been replaced the previous agricultural property, the APR will be available if period of ownership of both the properties at least 2 years in previous 5 years if the property is owner managed, but if it is tenanted, then 7 years out of 10. So if the owner manages it, it is same out of 2 out of 5, it should be in your hands for 2 years. But if it is tenanted out of 10, it should be 7 years. For successive transfer, no need to consider ownership period, and APR will be available if the following conditions are satisfied. Again, like that, the property being transferred was inherited, and the first donor qualified for APR, and any of two. Either the property was transferred due to death of the first donor. If this is meeting, or if it is not meeting, then the property is now chargeable due to the death of the second donor. In this, any of the as explained in BPR, any of this is any of this condition is met, there is no need to assess for the BPR conditions. It straight away qualifies. APR conditions, it straight away qualifies for APR. Now there is a farming company, and if we have shares in that farming company, what are the guidelines for that? If the individual has shares in the farming company, APR will be available. If individual has a controlling interest in the company, obviously if you're not having the controlling interest, it won't be available. The minimum period of ownership is satisfied. The minimum period of ownership remains the same. APR is equal to agricultural value of that company into the shareholding gifted multiplied by the appropriate APR percentage. This will be the relief. APR is withdrawal. Again, like BPR, we will be assessing it again on the death, and if the conditions are not being met, we will simply be disregarding APR as we have disregarded BPR. Agricultural property is not used for the agricultural purposes anymore, or agricultural property has been sold by the donee by the date of death of the donor and has not purchased any replacement agricultural property. If both APR and BPR are available, APR should be deducted first. What is the reason? And then BPR should be available on the remaining value. How do we say that? What is the main reason for this? Ravi, Evelyn, Etisham, Tommy, can anybody please answer? Come on, guys. Not sure. Okay. Anyone else, please? I'll be explaining that. It is pretty simple. You've seen that in APR, it is an agricultural property that is qualifying for the relief. There might be some constructional value or some commercial value of that property still being left. So after the application of the agricultural property relief, we might be able to apply the business property relief on the remainder. So that's why we apply APR. Yes, developmental value. I was not remembering the word of the exact word, that is development value. So on the development value, BPR can still be available after the application of APR. That is why we prefer applying APR before BPR. Okay, guys, I hope this is clear. If there is anything else, please let me know. And let's move to the question. Okay. Again, the art of reading the question is you read out the first paragraph, you read out the requirements, and then you create an answer in your mind by thinking it twice. Now, what is the question here? There's a person, Akhil, who requires advice on the capital gains tax and IHT implications of gifting a warehouse to his daughter, Damia. He also requires an advice on the tax consequences for the company in which he is a director and shareholder of its disposal and acquisition of certain capital assets. Now, you could see that in this question, Akil is requiring the advice for both the capital gains tax and IHT implication. In first case, it is the warehouse that is being gifted to her, to his daughter, Damia. Further, the other thing under consideration is the tax consequences for the company in which he is a director and shareholder, and he's going to dispose of its capital assets. So we could see there might be applications of different reliefs from CGT and some reliefs from IHT, but we need to look at the requirement first so that we could understand what is being expected. What is the question is worth 20 marks, and it has two parts. The first part is again comprising of three subparts having 2, 5, and 5, 12 marks in total, and 8 marks for the B part. Now you could see that what is required here. I'm just shrinking this down. In respect of the proposed gift of warehouse on 1st October 2018, explain why capital gains tax relief will be available. It is pretty straightforward question. It says why capital gain tax relief will be available. Can anybody throw light on it? You're still not sure, Ravi? Okay, I will wait for the answer. Meanwhile, I'll go through the further analysis of the requirement, but this is pretty straightforward. You could see it is worth 2 marks. It says explain why capital gains tax gift relief will be available. It is very simple. Daughter cases involved. Akhil is going to give a warehouse to his daughter. So it is between the connected persons. So I'm giving you the hints. Please thought it out. Further, the second requirement says this is worth 5 marks. It says explain with supporting calculation. The first part says the explanation. Only 2 to 3 lines for 2 marks will be enough. But when it says explain with supporting calculations, now again you are primarily being asked for the explanation. The calculations are going to support your explanation, but not independent calculations are required. Explain with supporting calculations the effect of making gift relief claim in respect of the warehouse on the total CGT liabilities of Akil and Damia. Okay, I hope it is clear that they want to ask you if they claim the gift relief, what will be happening for the liabilities of Akil, the father, and the Damia, the daughter. Most probably, the gain arising on Akil would be transferred to Damia, but we could see the details and then we could figure out our answer. Advice on the availability of business property relief for inheritance tax purpose if Akil dies before 1st October 2025. It is looking for if the gift becomes chargeable or not chargeable, again for the 5 marks. They are asking you for the advice. I told you on a very first session that if it asks you for the advice, your advice should be clearly directed towards the issue raised in the requirement. You cannot give any suggestion that is not conclusive. You have to advise, and the advice in that case will be crisp, crunch, and clear. Okay, let's move to the second part, B part, that is worth 8 marks. Explain again with the supporting calculations. I have stressed enough on this supporting calculation. They mean that they are supporting your explanation. Your explanation is better understood with these calculations, but you just cannot do the calculation and consider that the person will understand. You are not understanding the question in that case. The amount of the after tax proceeds, again after tax proceeds, this has been discussed time and again by the examiner, that after tax proceeds, they say that the proceeds are the sale proceeds, and after tax, either it is the tax chargeable, either it is a tax saved. The netted impact of both these things is required in after tax proceeds, which will be available for the sale of the fixed equipment, and the tax consequences of both Spydra Limited and Basser for of the gift of the motorcycle. Total question worth 20 marks. I see the question tab if there is any question. Okay, Evelyn, Tommy. Okay, they say because there is a business asset being gifted. Okay, good. More than 2 years. Okay, business asset, Bodon and Dhoni. You can very good. Bingo. You people are right on the money in this case. Thank you, and I am impressed. And I pray and I wish you very good luck for your exam so that you score good. Okay, now let's just go through this detail. Okay, what about Akil and Damia? They are both resident and domiciled in the UK. Both are the high rate taxpayers in all relevant tax years. Now, one thing I would like to tell you here is it is telling you that both are high rate taxpayers. So if you are a high rate taxpayer and you are going to calculate any CGT, you should know that there is no unused basic rate tax band available. It is clearly saying that in all relevant tax year you are a higher taxpayer. You don't waste time on the unused basic rate band calculation. Both make disposals to fully use their annual exempt for CGT each tax year. So while considering additional tax impacts, you are not going to consider annual exemption amount. You are not going to consider that annual exemption amount is going to save you any taxes because it is already fully utilized. Okay. Now, who is Akil? He's a director and a 55% shareholder in S Limited. That is a UK resident and a trading company. So, trading company is resident there, and he's a majority shareholder. Okay, will give a warehouse building to his daughter Damia on 1st October 2018. So, it is pretty much clearly meeting the conditions. Akil's warehouse acquired the warehouse on 1st July 2006 at the cost of £62,000. The cost was £62,000 and it was acquired on July 2006. Okay, you have to highlight these key information points. The warehouse has always been wholly used rent-free by S Limited since that date. The current market value of the warehouse is 195,000. So the cost was 62,000. The current market value is 195,000. While making any calculations, we will be using that current market value. Damia will use the warehouse solely in her sole trader business. Okay, we have the information about the intended use of the gift being made from father to the daughter. Intends to retain and use the warehouse until she sells the business in 5 years' time, when the warehouse is anticipated to have increased in value. So she is going to have that in with her for 5 years, and it will be disposed of when the warehouse is anticipated to have increased in value. Only if the value is increased, then it will be sold. This is the intention. But the reality or what has actually been done on ground is not mentioned here. S Limited prepares account on 30th June each year, is owned by Akil and Besser. Akil being the majority shareholder and Besser being the other side, not the majority shareholder. B is connected to Akil, is not connected to Akil, and is neither a director or employee of S Limited. So if there was any chance of me making any sales of its shares and they have to look for the application of entrepreneurial leave, it would not have been applicable for Bassett because he is not a director or an employee of the S Limited. What is S Limited? I am seeing that we are running late on the clock. The session is about to the closure. We'll just end up by concluding this question. By reading out this question, we will be attempting the solution tomorrow, hopefully. But let's conclude the question. S Limited sold an item of fixed equipment for proceeds of 20,000 August 2018. The equipment has been purchased on 1st May 2012 for 65,000. The tax written down value of S Limited main pool was nil. It is providing you all the relevant information. Rollover relief was claimed on the purchase of the equipment to defer a chargeable gain of 38,000. It is telling you that it was claimed, and when it was claimed, what it actually did, it deferred the chargeable gain of £38,000. As Limited will use the after-tax proceeds from the sale of the item of fixed equipment to purchase motorcycle, which it will in turn, which it will give to Bassett. So this is the whole question. You have seen that what S Limited is doing, what Bassett is doing, what Akil and Damia are doing, and uh, upon those upon those facts that have been mentioned in the examination, you have to address these four requirements having 2, 5, 5, and 8 marks. If I quickly go through the first answer, explain why capital gain tax gift relief will be available. I asked you, let me check the question tab if anybody has managed to answer. Yes, you people have already answered. I've seen it. So the answer is right. Let's just quickly wrap it up. CGT relief is available because the warehouse is a business asset which has been used throughout Akil's period of ownership by S Limited, which is Akil's personal trading company, as he can exercise at least 5% of the voting right because he's 55% controlling the company. The Dhoni Damia is UK resident. So this is how the basic reliefs that CGT reliefs are applied here. Okay, guys. For the bigger parts, we will be attempting the question tomorrow. I am again requesting you if there are any specific topics that you want me to cover in tomorrow's session, I will be covering them. For the guys who want to know that what topics we will be covering, I have noted with me. I have to put light on the de minimis limit of the value added tax plus share schemes, and there was this. Okay. Okay, guys, this is it. We will be covering value added tax, we will be covering share schemes, and any other topic that you may ask me will be covered tomorrow. Plus, the WhatsApp group will be made, and even if the session ends, there are any problems, you are welcome to ask. If there are any questions for today's session, you have 2 to 3 minutes to ask me before. So you may proceed with the questions, and then we could call it off for the day. Okay, Ravi, I got you WhatsApp text. Guys, those who have texted me on the WhatsApp, thank you very much. I will be making the group, and the people who have not yet texted me, please text me so that I could make the group once and for all. and I could add the guys who really wish me to add them. Tommy, you still with me? Okay. Intisham, one question will be dealt with on Excel, no worries at all. And we will do that. Is it possible for it is going to? Yes. Evelyn, I am writing my number in the very correct format. The country code is 0092. Uh, this way you can easily add me. If still you are unable to add me, I will add you myself. You could share your number, please. Okay, guys, let's call it a day. At the same time, is it possible for a disposal to qualify for? Sorry, I can't see your number. Okay, I will write it again. If the conditions are met, yes. If the conditions are not met, no. I've written it down again for you. Investor relief basically is extending the benefit to the investors who do not meet the conditions of BADR and is subject to a separate lifetime limit of 10 million of qualifying gains which are taxed at 10%. It is applied on disposal of unlisted ordinary shares in trading company including AIM shares subscribed for newly issued shares on or after 17th March 2016. You could see if they are issued before 17th March 2016, they cannot qualify, but if they are issued after this date, they can qualify, which have been held for the minimum period of 3 years, starting on 6 April 2016 by an individual that is not an employee of the company. So the conditions of both are totally different. If the conditions for ER are met, we are going to apply ER. But for some cases where ER is not being applied, we are going to use this. Okay, guys, let's call it a day. Thank you very much for your cooperation and your time. Uh, it is really an honor uh, for conducting such interactive session, such interactive webinar in which you people are continuously asking questions and telling me the topics to cover. Thank you so very much. And if there are any problems, you can contact me on WhatsApp and my email as shared. Thank you very much. Good day. Bye-bye.